Okay, hello everybody, and welcome to Investing with IBD, sponsored by MarketSmith. Today is October 21st, 2020. I'm your host, Arusha Pierce, and today we have Austin Lieberman on the show. Austin is a lead advisor for 7investing.com. Thanks for being here, Austin.
Yeah, thanks for having me. A big fan of IBD, big fan of yours, Arusha, and just really happy to be here and thankful to be here.
Thank you. On today's podcast, we're going to talk about the current markets. We're going to talk about the concept of not being afraid to buy an expensive stock, and then we will end the episode with a few current ideas. So let's get into the current market. The current market is in a confirmed uptrend. We have distribution days, 1 on the NASDAQ, 2 on the S&P 500. Austin, what are your thoughts about this market?
You know, it seems like every day there's something to either be bullish and excited about or something to be bearish and nervous about, ranging from anything from politics to coronavirus to vaccines, or on the bullish side, or just anything, right? And
Yeah.
it seems very stressful and nerve-wracking, but if we just look at the history of the stock market, right, volatility is normal. And at any point, the way I try to think about it is, I don't know if the market is fairly valued or overvalued. I try to think with a mindset that it's either like 10 to 20% overvalued or undervalued. And I think about the stocks I own this way too.
Mhm.
At all times. I just don't know which one. And so when I invest, I try to invest with a long-term mindset and knowing that I need time on my side. And then that allows me to kind of outperform that potential 10 to 20% either over, being overvalued or undervalued. And so it just helps me kind of stay centered and humble as an investor to realize, like, I have no idea what's going to happen in the market over the next week, 6 months, or whatever. But it generally, if we look at history, the market goes up over longer time periods.
No doubt. We have a long-term bias to the market, and I think one concept that you touched about, maybe go into this a little bit later, is knowing yourself, right? Knowing what works for you, what makes sense to you, and if that's working, just keep doing it. So those are very, very important concepts that you touched on there. So let's get into first, take a step back here, and how did you get involved in investing, and walk us through the path of how you ended up at 7 Investing.
Yeah, really kind of by luck is how I got involved investing. And that's something that I've become very passionate about trying to change for people, is not make it lucky that somebody comes across and starts investing,
Yeah.
but hopefully get people more exposure to that. And if nothing else, COVID and everybody being at home, and as much negative narrative as there is around like the retail traders and all the craziness that might be happening right now, investing is getting a lot more exposure, right? And so maybe we can get that momentum going in the right direction and help people become like long-term productive investors. And so, yeah, my story is, I grew up in a family that we didn't struggle, but we lived paycheck to paycheck.
Okay.
Never talked about money. My parents were too proud to admit that, sometimes we struggled to pay our bills each month, or they couldn't afford to do things for me. Uh, and so I didn't have like a lot of exposure to the stock market. In 5th grade, which is actually really rare, we played a stock picking contest.
That's amazing.
And
Yeah.
yeah, crazy, in 5th grade. And I just happened, I think we picked like 4 stocks, maybe 5. And I don't remember all of them, but 2 of them were AOL and Disney, because Peter Lynch style, right? Those were the brands that I used AOL Instant Messenger all the time as a kid. And I browsed the internet, and then I loved Disney. And
you're making me feel old, Austin, if you're 5th grade and you're using AOL at that point.
You look great. You look super young and hip. So I feel old too. So it's all right. But it was, the thing I remember from that is just, in a matter of whatever it was, a few months or 6 months or whatever, Disney and AOL did really, really well. And it was cool. They had us ranked and stuff like that. And it was fun to see those rankings. And so I learned like what stocks are. And then going through college, I started college on a 50% scholarship. And this is back to the whole finance and money thing, right? Mm-hmm. And my parents were going to try to pay for the other 50%. I got a letter from the registrar's office 2 days before I went home for uh, Christmas break, basically saying that none of the tuition had been paid at the university. And I talked to my parents, and I just realized like they were trying so hard, but it wasn't realistic. They were going to go into so much debt to try to pay for my college. So I packed up, moved back home, went to community college for the rest of that semester, worked and started in school, did some training, and ended up commissioning as an officer in the Air Force. And your senior year as a cadet in ROTC, it's pretty obvious that you're going to graduate and have a job. So there's things called cadet loans to kind of get your career started.
Okay.
They're meant to like help you move and pay bills and stuff like that, because you might not be able to work your last year of college as you're focused on training. I wasted like half of that on a cruise, 2 road bikes for myself and my at the time fiance. We paid for like part of our wedding. I paid for our my wife's engagement ring, and then I had about half left over and invested it in what Jim Cramer was talking about on Mad Money, because I thought that was investing. And I bought like Annaly, which was a REIT, AT&T because it paid a dividend, and then some like triple leveraged volatility index that, looking back, they're like basically guaranteed to go to zero if you own them long enough. And I lost like 50% of what I invested and thought investing was a scam and a ripoff and didn't want anything to do with it.
Yeah,
so fast forward,
and really at that,
go ahead.
and really at that point, most people will quit. It's like, all this investing thing, it is a scam. It's a scam. I'm never gonna do this again, and they're gonna tell everyone else too. Hey, or they may or may not, but depending whether they want to admit what they did. But that's where a lot of people will quit. So really, what helped you kind of not do that?
Yeah, I did. I mean, I did that, and then I just came across somebody at my first assignment as an active duty officer in the military. So I had an income, met real adults after college, and kind of a mentor of mine was just talking about how he had owned some stock in Netflix for a few years. And this is around like 2012, maybe 2013. He had turned like $6,000 into $90,000 or something crazy. And that's rare, right? Like that doesn't always happen. But he also owned some other stocks and was long-term oriented. And so that was the first time I really saw the life-changing impacts, because he was a little later on in his career. He was at the point where he could leave the military if he wanted to and go do what he wanted, because he had kind of reached financial freedom. I was like, wow, okay, investing long-term, if you do it the right way, can be a real thing. And then from there, just kind of dove in headfirst. I don't have any finance, professional or educational background in finance. I'm a criminal justice major, but I've just been a super fan of business and learning and podcasts. And then you asked about the 7 Investing thing. I kind of had my own little email newsletter, was talking about my process and writing and how I invest. Simon Erickson, the founder and CEO, found me, reached out, we connected, and he gave me an opportunity to join the team. And we launched in March of 2020, and it's going pretty well so far.
That's really cool, and we've had Simon on the show before. I think that's really interesting that you took something that you're passionate about and you kind of took the next step. You started your own service and then got discovered. Walk us through just a little bit about that, just kind of the process of how you discover stocks or how you learned stocks, because that's not an easy thing to do too. Just especially if you didn't have any background. I was kind of like you, where I was a bio major in college, and I didn't do anything on stocks. And but after once I started working, I started realizing, this money thing might be a good idea to start making more of. And I just being around others who were getting into the markets and reading around, I started discovering and learning from other people who actually did well in the markets. And so some of that process, just walk us through about what you look for in stocks a little bit, to make you think that it's a good investment or not.
Yeah, sure. And so I try to cast like a wide net, right? And I don't call myself a growth investor or a value investor. a lot of the companies I recommend, just because I love the business model, which we can talk about, are kind of software oriented companies. And then one thing I do look pretty specifically for is founder led companies. But I can kind of just share what the evolution of a company, how I might hear about a company, start the research, and then how it ends up becoming either a company I own or a recommendation. And so really, I try to read and listen widely, right? And so investing podcasts, which this one, and then this is my second favorite podcast, of course, and then my favorite is obviously Seven Investing. So if you're looking to learn about
that's
investing,
totally fine.
start there, right? But
Yep.
seriously, that's how I started learning, is just finding investing podcasts that I connected with and related to. But now, I'm pretty active on Twitter, and so we see a lot of research firms or even companies are out there talking about, uh, you know, almost every company you can think of, if it's publicly traded, has a Twitter account. And so I'll scan Twitter. I've found a couple companies that I own from. It was Deloitte's 2 years ago. Every year they release
and the reports.
The fastest 500. I think it's 500 growing companies in America. And every year that report comes out, I take all of them. I use Y charts and put them into Y charts, see if they're publicly traded, and then just kind of look at the quick what the company does and some of the data around it, the fundamentals, and say, is this a company that I want? That's like a 5-second process.
Yeah.
If it's a possibility, then I'll add it to another list, and then that's where I dig deeper. And so once I have, these inputs of companies that I think I'm interested in the industry, because it's a big and growing industry. I think I'm interested in the business because it seems like they've got good management and a product that is they've got good sales, and recurring revenue is something I like. It'll be on a list, and it's easy to kind of throw a lot of companies out that don't meet those high level criteria to save yourself time. And then once I have that list, and that could be 50 to 100 companies, that's the list of companies that I'll go really deep into. And then the way to do this is, and this is all publicly available, is check the SEC website and the company's investor relations pages. There's all kinds of events and webinars that these companies do, and presentations where they talk about their products and what their sales are, listening to earnings reports. And so the types of companies that I'm really interested in right now, like I kind of talked about, are software based. And the reason for that is because the world, as we've especially seen it now, but even before COVID, is forced to move more digital and more software, right? And so what used to be moats, these things like even vehicle production or oil manufacturing, and these different things, like the distribution capacity that used to be called moats, that are high capex and cost a lot of money to build out, have actually started to become liabilities, right? And the companies that have digital products, or a company like Shopify that can expand stores almost instantly and sign up more people who are moving their businesses online, can basically create more sales for little to no additional cost. They don't have to produce a new physical thing that costs a lot of money, or build out a new oil line, or deliver a new vehicle. Very scalable business models. And so I look for, generally revenue that's growing 40% or faster a year, high gross margins. And what that looks like is like 80% gross margins plus. And then another kind of data point is dollar-based net expansion rate. And with software businesses, all that is if it's over 100%, that means customers are spending more each year. And if it's under 100%, then they're spending less. So generally, I like to look for 130% or so dollar-based net expansion rate. That means that they don't have to spend as much marketing. They've got their customers, and they're able to get more spend from each customer, as well as sign new customers.
Perfect. So let's take a quick break here, but the market is in an uptrend. But remember, we are in earnings season, so just make sure you know when your stocks are reporting earnings. When we return, we are going to talk about not being afraid to buy expensive stocks. We'll be back.
I am here with Scott St. Clair. Scott's one of our senior product coaches at MarketSmith. Now, Scott, there are a ton of publicly traded stocks just on the U.S. I think it's over 5,000 stocks. Who has the time to go through all of these stocks and find the very best ones?
Yeah, most people don't, right? So what you need is a tool like MarketSmith. We have decades of research on what makes a great winning stock. So we've done all the research for you. So we're going to try to highlight those specific stocks with those great data points. So if you're looking for that next great potential big winner, orange stock ideas button, you just click on it and you've got some of the main reports that we use, including the Growth 250.
Yeah, and the Growth 250 is the first list that I go through on the weekends.
Yeah, it's the most popular one, but there are others. There's the Breaking Out Today, Stocks Near a Pivot, and then the Blue Dot list, right, which is very popular. It's going to show you the stocks with the best relative strength. So we've done a lot of the work for you. What you have to do is review these lists. You're going to come up with some of the best ideas in that current market environment.
Perfect. MarketSmith saves you time and makes investment research that much easier. For more information, go to investors.com/podcast2020.
Austin Lieberman's our guest on Investing with IBD, sponsored by MarketSmith. Okay, Austin, let's talk about the concept. And this is where most people, especially when they're starting off new, they don't want to buy expensive stocks. And I think let's first go into the definition of what's an expensive stock, or a few definitions we could really go into of what the traps that people fall into. And then we can talk about why you don't want to be afraid of that. So let's first go into what is an expensive stock.
Yeah. Great question and an important question, right? And so, there's definitely stocks that people call expensive that are expensive and that I, avoid. And so it's not as easy as just like the Peter Lynch thing is like invest in what you know and invest in great companies is great. And it's true in a lot of ways, but you do have to kind of dig into the numbers a little bit and make sure we're finding great companies, right? But when you find a great company in an important industry with great management and great products, it is almost impossible to overpay. And the common examples, if we just look back at history, right, are the companies we see out there today: Amazon, Netflix, Google, like all of those super famous companies at this point. And so I actually pulled a little chart, right? And back to 2004, which is before the great financial crisis and almost, arguably one of the worst times to invest over the last couple decades, putting $10,000 into Alphabet, Amazon, Apple, Netflix, and Activision Blizzard. So you're talking about 50,000 total at that point.
Yeah.
If you just held on, right, has turned in, and those were all arguably expensive stocks back then.
Right.
But also like products we all know, and they had great numbers. That would have turned into, over $5 million, turning 50,000 into over $5 million. So that's an example of what we're talking about. If you can find great companies, invest in them, and then hang on to them, it's almost impossible to overpay. And so I still think those are really interesting and great companies, right? But there's a couple that are a little bit more relevant today. I mean, or not trillion-dollar companies today, like Amazon and Apple. And so there's two, Shopify and Zoom, right? They're pretty popular out there. And I actually have a story with Shopify of a mistake I made, and I kind of fell into the trap of, this is an expensive stock. I've already made 50% or more. I'm going to sell it, and I don't like buy low, sell high, right? I don't want to give back these gains. So I own Shopify. I think I owned 200 shares of Shopify back in, and I'm not looking at it, 2016 or 2017. Yeah. But honestly, it doesn't matter. If like, no matter what time I owned it back then, up massively now. And I owned it at around $40 a share. And I think I sold it for 50 or 60. So I made a nice 50% gain, right?
Yeah.
But it was expensive. I was reading articles about how Amazon was going to crush them, and it was expensive on, and you asked a very specific question, what's expensive? So generally it's like on a PE, price to earnings ratio, or price to sales ratio, right? Yep. And so there's certain numbers, like a lot of people say something over a 10 price to sales ratio is expensive or whatever, but that's what we're talking about when we're saying expensive. Well, Shopify has gone from $60, which was expensive back then, to $1,000 a share. And if I would have just held those 200 shares, I wouldn't have to be doing this podcast with you today. I would be on vacation with my feet. I'd be taking pictures of my feet in sandals on the beach.
Exactly. Yes.
So
well, and Austin, one other way for that people fall in the trap, and so those are you're right. Those are kind of the traditional gauges: the price of earnings, price of sales. But people will also fall into the trap of just looking at the price. So even a Shopify, well, it's maybe $400 earlier this year, and they're saying, oh, it's $400. I'm not going to pay $400 for a stock. I'll buy a stock that's $20. And meanwhile, here's Shopify going up more than a double during that time, and maybe that $20 stock has only gone up 3 points during that time.
Yeah, great point. And that's kind of the common thing is associating the price of shares, so $20 versus $400, with whether or not a stock is overvalued, and it has nothing to do with it. What matters is how many shares are issued, and then either what their sales are, and then how it's valued from there. So yes, don't associate, and especially when we're talking like penny stocks or something sub $10. There's usually a reason it's sub $10 a share, and that's the one time I actually generally try to avoid stocks that are under $10 a share.
Yep.
Because there's some reasons that go into that make them they tend to be a lot riskier than other companies.
Yeah, and a lot of times, if it goes over $100 a share, that that's a big positive for me. If it's a great company and now it's hitting over $100, a lot these days I'm focusing a lot. Most of my stocks are over $100. They've done that well to get over that price, and they just actually might be getting rolling at that time where they can go from 100 to 200 pretty quickly.
Yeah. So let's talk about another one real quick, and that's Zoom, right?
Yep.
Zoom is up, I don't know, 600% year to date or something like that.
Yep, something crazy.
It was
like
expensive when it IPO'd a year ago or a year and a half ago at $60 a share. It was expensive at $100 a share, and people are saying it's expensive now.
Right.
I think that Zoom is going to continue to outperform the market. And so I'm going to sound like I'm like eating my words here, right? Or I'm hypocritical, but I own Zoom for pretty much all of that 600% run up. And I just recently sold my shares.
Okay.
But I did not sell my shares because I think the price to sales ratio is too high or anything like that. Market cap, right, is something that I look at in companies that I own, and Zoom has about $150 billion market cap. And so for me, when I look at that, it's harder for me to see Zoom doubling or tripling, which is something that I like to look for in the stocks I own. It's harder for me to see them doubling or tripling faster than some other companies that I really like right now. So full disclosure, I recently sold Zoom. I might change my mind and buy it again. But at the same time, I still think it's going to outperform the market. And the thing I want to share is just like why these software businesses are so impressive and so scalable. And then especially Zoom specifically, their revenue in their most recent quarter grew 355% year over year. There's no business on the planet at that scale and that size that's growing as fast as Zoom. So they have $2.6 billion in annual revenue, growing at 355%. I said I like companies growing faster than 45%.
Yeah.
And then that dollar-based net expansion rate, right, it was 130% plus. So that means current customers are spending 130% of what they spent this year, next year.
So walk us through that concept, because that's an important concept, especially when you're looking at software stocks, like you stated before. So a company might come in and spend that 100% initially, right? They're like, okay, let's just try the basic Zoom package, and actually, I mean, we're a perfect example of this too. We got a few licenses for Zoom initially, and now we slowly expanded. Now we're looking at upgrade stuff. So go through that kind of process of why it goes over 100%.
Yeah, that number matters. that's one of the most important numbers for these software businesses. And the question is why, right? Because it's an indication at how well they're serving their customers and how fast they're innovating and coming out with new products that their customers are buying, right? So
Mhm.
what that tells me is that, just like you said, Zoom's customers, their current customers, are probably buying more licenses and expanding. But if we look at what Zoom has done over the past year or 2 years, they've released and expanded the Zoom Phone. They just talked about opening up a marketplace where people can pay for specific services and build apps on top of Zoom and stuff like that. All of that stuff is being offered to current customers. And so when we see customers are spending 130% in the next year, they don't have to go do a bunch of sales and marketing, which can be really expensive. They don't have to get their brand name out there and try to bring on new customers. That's all stuff that they release. And if you're a Zoom customer, you probably get the emails. They just send an email out. Hey, this is available.
Yeah.
Do you want to try Zoom Phone and simplify your communications? And that just means their customers are clicking on that, saying yes, and upgrading and spending more money. And it's just a incredibly reliable indication that they're innovating, their customers are happy, and their customers are staying with them and spending more.
Yeah, and of course, and once you get used to this, or when you integrate some of these software into the service. Now, Zoom is one example, but like for instance, like a Five9. I mean, we use Five9 on as our phones is like that. The switching costs are insanely high. Even if you wanted to get off of it, you have to think really long and hard. Do I really want to go through that whole process and switch to another thing, or you know what? Maybe I'll just go with this new Five9 service or new add-on that they've added versus maybe something else is better out there in the market.
Yeah. Yeah. And last thing on Zoom, real quick, right? And this is what's so impressive. I talked about how fast these companies can scale for very, very cheaply, right? They don't have to open a new manufacturing line or anything like that. In Q3 of 2020, their annualized meeting minutes were 97 billion. So 97 billion minutes of meetings in Q3 2020.
Okay.
Q3 2021, 3.3 trillion
oh my gosh.
annualized meeting minutes. And so that's not necessarily all new customers, right? But that's the amount that people are using the platform. So they were able to, I don't know, whatever that is, 1,000x the service on their platform in a matter of a year. That's unheard of, and it wasn't even possible, a couple years ago to do that. But with the cloud and the internet and all that stuff, like, businesses can now grow faster and more reliably than ever before. And this doesn't mean like there's going to be 10%, 20%, 30% pullbacks. It's going to happen. But if we think about 5 and 10 years down the road, I'm just very optimistic on businesses that are digital, able to scale and innovating, like Zoom and even Five9 and many other companies out there.
Oh no, it isn't. Like you, Austin, I gravitate more towards software companies because they just make a lot of sense, and because of that scalability. I still own both Zoom and Shopify, but I always just I just know in the past, and I'm sure you've experienced this too. I've just done better at a lot of technology-related companies than other ones, just simply because I can understand them better. And in the end, they just seem to have a little bit more power when they're in favor.
Yeah. So why aren't you on an island somewhere? I'm just kidding.
that is a good question. I'm addicted to this.
You still hold them. You still hold them. So that's why you haven't realized this.
Yeah, the sad thing is, like, even if I could go to an island somewhere, I'd be doing the same thing. It's a great thing. I'm like you. I'm addicted to the markets. I love finding great ideas, and you know this too. It becomes so much more fun as you get better and better at this too.
Yeah. Yeah, it's fun. And it's fun to share it with people too, which you all do a great job of.
So. Absolutely. So remember, with better quality items, a lot of times they are going to be sold at higher prices, and it's no different in the stock market. So coming up next, we are going to talk about a few ideas. Stay tuned.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
We are back with Austin Lieberman on Investing with IBD, sponsored by MarketSmith. Okay, Austin, let's go over a few ideas. And the first one is BioLife, and the ticker symbol is BLFS. And so what do you like about these guys?
Yeah, so I'm going to go out on a limb and say that no one on this show has ever talked about this company before. Is that true?
Yeah,
All
yeah.
right.
I haven't, honestly, I haven't heard of this one.
Yeah, I wanted to, bring some companies that maybe people that aren't talked about so much, or that people, haven't heard of as much. So yeah, what they do is the company develops and manufactures biopreservation tools and services for cells, tissues, and organs, including clinical grade cell and tissue hypothermic storage and cryopreservation, freeze media, and a related cloud-hosted biologistics cold chain management application for shippers. So I just read you the description from YCharts, which is a tool I'm a huge fan of, right? And so I'm not a scientist or biologist or anything like that. That's a very technical description, right? But what the company basically does is they help cell and gene therapy companies. So when we hear about CRISPR and all of these different tests, even for coronavirus, all of this cell and gene therapy stuff, which I believe is an industry that as medicine gets more personalized and we're able to do more different tests with blood, I just think naturally that market is going to grow a lot over the next 10 years. And again, I talked about, I'm not an expert by any means in anything medically related, right?
Mm-hmm.
But what I do believe, so when and saying that, I'm not able to make a bet on a company that's going to get an FDA approval for some type of cell and gene therapy. That's just not what I invest in or how I do my research. And I'm not smart enough. I don't have that background. I'm a criminal justice major. But logistics and helping the companies that do that cell and gene therapy, freeze it the right way, store it the right way, ship it the right way, and thaw it the right way. They call it almost like a picks and shovel type of company.
What I was thinking. Yep.
Yeah. I'm not investing in this company. I'm not reliant on an FDA approval. I'm just betting that cell and gene therapy as an industry is going to grow over the next 5 and 10 years, which it's pretty obvious that that's going to happen. Mm-hmm. And then I think BioLife Solutions, a $900 million company, so this is a smaller company, is going to continue helping those customers and grow over time with them as the industry grows. So it's kind of investing, and I own shares. Investing in this company is my way of betting on cell and gene therapy without needing to get deep in the details of what trial and who's going to get the FDA approval and stuff like that.
No, I like that approach, and I've always liked the pick and shovels approach, because then you don't have to necessarily pick a specific winner. You can just pick the trend and really go with some of the ones that are providing the equipment to enable those trends. Are there any other kind of major competitors in this space for a BioLife, or are they kind of doing something pretty unique?
Yeah, and that's the thing, is this is a small position for me, right? They certainly have competitors. There's large companies that they compete with, but there's another company called Cryoport that they directly compete with. And in fact, a few of their customers are BioLife Solutions customers and Cryoport customers, because it just makes sense to have multiple kind of vendors if you're going to do that. So it's definitely something to watch out for, is either a bigger company that's doing something like this, just kind of pushing them out of the market, which they've actually been around for a while. So I don't know that that's going to happen. But it's a competitive space for sure. I just think there's going to be room for multiple winners. And so just, some quick details about the company. It's about a $900 million market cap company. They have, in the first half of 2020, they had 77% year-over-year revenue growth, which is pretty good. That does include some acquisitions. This company's kind of a serial acquirer of other businesses to grow their capabilities, which is actually can be good if they've done well. The stock's actually up about 1,000% over the last, I think it's over the last 5 years. So one thing I look for is stocks that have outperformed to continue to outperform.
Yep.
But it's still a $900 million company, so plenty of room for growth. They've got some pretty marquee customers, and this is just from one of their presentations. But Celgene is a customer, CRISPR is a customer, Editas is a customer, Novartis, Kite Pharma. Looking for, I thought there was one more I wanted to point out, but the point of that is,
those are big names,
they've got some pretty reputable customers. It's not like they're just serving these super small companies. And it's performed well over the last 5 to 10 years, which is something that I look for in companies that I own.
Perfect. So that's BioLife Solutions. The ticker symbol once again is BLFS. Let's go to our second stock, and this is GoodRx Holdings. And the ticker symbol for this is GDRX, and they just went public in September.
Yeah. So, more people probably have heard of GoodRx, and you'll be able to tell. I just, like we've talked about, I look for kind of big themes, right? And so cell and gene therapy, I think, going to be big. And then what we've already seen to be big, especially with COVID, is digital health, telehealth, and in general, just making things more accessible to people that once they had a painful process and they had to go do it in person. And so if there's anything that comes to mind when I think about that, going in person and it being a pain, it's getting medicine, right? Especially for people that are trapped in their homes, especially for people that might have certain diseases or diagnosis. The older population who is more at risk or immunocompromised, with things like COVID. So again, that's kind of the theme that I'm investing behind with this. And then I just like the fact that they are basically trying to bring patients and providers and pharmacy suppliers together through a really easy to use digital platform. They actually save customers a lot of money, and they have created a reliable platform in the way that they're able to save money is the providers and the even the care clinics and stuff that they're partnered with have a reliable source of revenue from the customers on the platform that that can help them grow the revenue. So actually, there's nearly $300 billion, and this is in the US alone, in costs from non-adherence. That's people that get prescriptions and then never actually go get them filled. Oh, wow. And so one of the selling points and how GoodRx is able to get the pharmacy providers on the platform is by saying, we're actually helping narrow that gap. And so even though you might sell them for less, we're going to be able to bring in more customers over time and more reliable customers and things of that nature.
Wow, that's so. How are they? So it's a platform that the customers are going. So the customers are the pharmacies at this point who are, or the regular patients.
It's kind of two-sided, right? So you've got consumers, and they say that they've all time they have 20 billion in consumer savings on the platform.
Yeah. And
then the customers on the platform are the consumers, which they've all time they've been able to save them. And this is from a presentation. They have $20 billion in consumer savings, but then they also connect them with pharmacies. And the advantage to pharmacies being on the platform is they get increased foot traffic because the customers of GoodRx are coming into their stores, which they could potentially sell them other things or other services or whatever. Right. Customer satisfaction is better. And then even pharmacy benefit managers have found the platform to be a proven growth channel. They can build long-term relationships with customers. And then the manufacturers of the different types of medicines, again, it's about being able to engage and convert users that are on the platform because they need, medicine,
Right.
they're able to convert that and grow kind of sales that way.
Yeah, a
So
lot of
that's,
times the secret is you create a community, right? And then you're able to provide ways to monetize that community. And it seems like
yeah,
that's what
and
GoodRx is doing.
yeah, and it's almost like a social media platform that's
Mm.
connecting in kind of the simplest terms, that's connecting users to businesses that are trying to sell stuff in one way or the other, except arguably GoodRx could be a platform that is, really, really helping people, whereas there's arguments to be made how helpful social media platforms can be
True.
to our
True.
attention spans and stuff like that.
That's
And then just, real quick, the opportunity, right? So they've got a slide in here. Zillow is a pretty huge company, and the real estate market is 2.8 trillion. Chegg is a book company, and the education market is 1.5 trillion. Booking.com is a pretty large company, and we're talking, hundreds of billions of dollars, the size of some of these companies, or at least multiple billions of dollars. It's a $1.5 trillion travel industry. Healthcare is a $4 trillion industry, which is as large as travel and education and then some put together. And so that's the size of opportunity that GoodRx has. And then from selling pharmacy and medicine and stuff, they're also trying to expand into different services and consultations and telehealth. So there's a lot of growth opportunities there.
No, that's really interesting. I mean, I've seen this company before. I just haven't really had the time to look at it, but you've definitely made me much more interested in it, especially with the earnings and sales are there, which is not always the case for a lot of newer IPOs. So that's GoodRx, ticker symbol once again GDRX. And let's go to the final stock, and this is one that you're not necessarily optimistic on, and it's BigCommerce, and its ticker symbol is BIGC. And why aren't you as optimistic about this company?
Yeah, and so kind of full circle, right? We talked about expensive stocks are expensive for a reason. I agree with that a lot of the times. Sometimes I think we have to watch out for them. And I could be very wrong on this company, but I think it's a good company, but I just feel like this is one where it's a little bit excessively valued. And let me talk about why, and I'll talk about it compared to some other popular e-commerce platforms that are out there, Etsy, even C Limited, which has, it's an international company that has an e-commerce aspect to it, and then Shopify, right? So we talked about price to sales ratio before. Shopify has a price to sales ratio of 57 and revenue growth, year-over-year revenue growth of 97%, almost 100% revenue growth.
Wow. Okay.
BigCommerce has a price to sales ratio of 46, so only a little bit lower than Shopify's. And in their most recent quarter, year-over-year revenue growth was 33%.
Oh.
So I have not studied BigCommerce deeply. They're an e-commerce platform. E-commerce is a very, very popular trend, as we know. But there's some companies that I believe we need to be wary of. And when a company like Shopify has a price sales ratio of 57, growing at 100%, growing revenue at 100%, that's pricey. But then when BigCommerce has a price sales ratio of 46 and it's only growing at 33%, there's other places that I would rather invest my money. And then Etsy, price to sales ratio of 15, and they're growing revenue at 136% year over year.
Wow.
So even if I wanted e-commerce, I just think there's better places to invest in e-commerce than BigCommerce. I'm not short. I wouldn't short it, but I'm just not interested in owning it right now.
No, and that makes sense too, because sometimes actually a lot of times, when the markets are doing really well, a lot of companies that were thinking about going public, they quickly rush in. It's like, let's try to get in there while the getting's good, right? And so you do have to be a little bit more cautious and do more due diligence for some of these newer companies, especially ones like a BigCommerce that doesn't have any earnings right now. They're coming out more a lot of times on the promise, and when you have other really great options out there, you have the luxury of picking and choosing.
Agree.
So there are a few ideas that are worth considering adding to your watch list. Thanks, Austin, for joining us today.
Yeah, had a blast. Thanks for having me. Look forward to just continuing to listen to the podcast. Thank you.
Perfect. Thanks. Next week, we will have Charles Harris returning back to the show. Charles is a portfolio manager for O'Neill Capital Management and a longtime portfolio manager for Bill O'Neill. So that's it for this week on Investing with IBD. I'm Arusha Paris, and thanks for listening.
And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.